Good afternoon, good evening, dear members and dear CA final students, those who are there along with us here today. I, CA Karan Chandwani, on behalf of the Professional Forum team, welcome you all to yet another webinar in this Mission Begin Again series post the lockdown, which is on Ind As 116 leases. And we have with us CA Akshay Oak today to guide us on this matter. Let me just introduce him first and then I'll hand over to him to start with the session. He has more than 11 years of IFRS, US GAAP, Ind AS, and financial reporting advisory experience. He was earlier associated with one of the big four consulting firms for more than 5 years. Currently, he is a partner at FinPro Consulting and a CEO and managing director at Lease On Private Limited. He has been instrumental member in the development of a software product, Lease On, which addresses IFRS 16, Ind AS 116 leases accounting and disclosure requirements. He is also currently working on various projects on implementation of IFRS 16 and ASC 842 leases. He is a regular speaker and trainer on accounting and financial reporting matters, namely Ind AS, IFRS, US GAAP, corporate law, etc., at various forums, including the Institute of Chartered Accountants of India. He has also worked on several projects on corporate fraud investigations in the past. With this brief introduction of you, sir, I would like to request you to please start with the session. Also, before you starting with the session, I would like to request all the members, like whatever questions you have, anything specific on this matter that you would like to ask the speaker, you can please type it in the live chat box so that we can have the question and answer session at the end for around 10 to 15 minutes if time permits. Sir, over to you.
Thank you, Karan. Thank you so much for the introduction. First of all, good afternoon, everyone, and thank you for joining today's session on Ind As 116 leases. I hope everyone is safe at their home and request all of you to take care. So basically, today we are going to discuss one of the most important topics that has been kind of deliberated across the industry as well as the auditors. The brand new standard, which is on leasing, Ind As 116 leases. So we are going to have an overview of this standard over next 1 to 1.5 hours, where I will explain you why this standard came into being existence, why there was a requirement, then what are the key provisions of this standard, and what is a big change that has come from the old standard on leases, which is Ind As 17, to the new standard Ind As 116. We are also going to discuss some of the key provisions relating to the recognition of assets and liabilities under the new leasing standard. So let me share the presentation with you, and then we will take you through this entire presentation in next 1.5 hours to 2 hours. I would request everyone to kind of submit all their queries in the live comments, and at the end of the session, I will take all your queries one by one and try to solve them. So I'm just sharing my presentation with everyone. Right. I hope everyone is able to see the presentation.
Sir, the
So,
PPT is visible. Yes, you can
yeah,
continue.
yeah, it's a PPT. Let me just introduce you the topic, and then we will take you through the key provisions of this standard. So, the IFRS 16 leases, which was introduced by International Accounting Standards Board. So, it was introduced way back in January 2016. And internationally, this standard IFRS 16 is applicable from 1st January 2019 onwards for the companies who follow the calendar year. So, most of the companies have already followed or implemented the provisions of this standard for their first financial reporting ended 31st December 2019. From an Indian perspective, Ind As 116 was notified by Ministry of Corporate Affairs almost 1 year before, to be specific, on 30th March 2019. And Ind As 116 leases is now applicable to all the companies following Ind As from the accounting periods on or after 1st April 2019. So the companies which are required to follow Ind As will be publishing their first results, annual results under Ind As 116 for the quarter or for the year ended 31st March 2020, where almost all the companies are in the process of finalizing their annual results. So to give you a background why this standard was introduced and what were the lacunas in the old standard Ind As 17. So as you know that you must have studied the old standard Ind AS 17 or even the old standard or Indian GAAP standard on leases. So typically every lease contract is classified as an operating lease or a finance lease. And if it is an operating lease, a lessee generally recognizes the rent expenditure in the statement of profit and loss over the lease term. And if it is a finance lease, the lessee basically capitalizes all the future payments at the present value and recognizes the corresponding lease liability. Now, you must be also knowing that there were various classification criteria on when do I classify a particular lease as a finance lease and when do I classify a particular lease as an operating lease. So, for example, if the lessee has a purchase option and the lessee is going to exercise that purchase option, then it will be a finance lease, or the ownership of the particular lease asset is going to transfer at the end of the lease term or during the lease term, it will be a finance lease. Or there were so many other criteria like if the lease term is for the majority part of the asset's economic useful life, then it's a finance lease. Or if the present value of minimum lease payments is almost equal to the fair value of the lease asset, again, it is a finance lease. So if you see these wordings, the majority part of assets economic useful life, the substantially all of the lease payments. So there was no clear cut guidance. There were no bright lines in defining what is major, what is substantial. So some companies took major as 75%, some companies took substantial as a 90%. So there was no standard rule on when a particular lease will be classified as an operating lease or a finance lease when there was a borderline case. So in order to remove this lacuna, there was a new concept introduced under IFRS 16 or Ind AS 116, which does not differentiate between the two models, that is operating lease and the finance lease. There is only one model under Ind AS 116 or IFRS 16, which is called as right of use assets model. So in this model, the lessee does not distinguish whether a particular lease contract is an operating lease or a finance lease, but treat it like a ROU asset model. So I will take you through what do you mean by exactly an ROU asset model. One more important criteria why operating lease and finance lease classification was kind of discontinued for a lessee was that some companies used to invest in the properties and even in other assets like cars, machinery, at the computers, etc. And there were some companies who used to lease such assets and used to classify same assets as an operating lease. So some companies used to take the impact on the balance sheet, that is assets and liabilities were on the balance sheet if it was owned assets. But some companies who were taken the leases on an operating lease, the all the assets and basically the future payments were off the balance sheet. So the investors were not really able to compare the two companies, where some companies had invested and some companies had just taken the assets on lease. So in order to introduce that comparability between two set of financial statements, the classification relating to the operating lease and the finance lease was discontinued with only one model for lease accounting, which is called as ROU asset accounting model. So why this Ind AS 116 is really important? Because as you know that companies have started going for an asset light model where most of the companies do not kind of upfront invest in the furniture, in the assets like properties, buildings, their offices, Even nowadays, a lot of companies have started taking vehicles or cars for their employees on rent. So, as I told you, under Ind As 116, there is no operating lease or a finance lease model, but there is an ROU asset model where all your lease transactions will be capitalized on the balance sheet. So, in a nutshell, all the lease transaction, except there are few exceptions that we will discuss later on, will be treated like a finance lease transaction. So even if you have taken a particular office on rent for, let's say, 3 years, which you had classified it as an operating lease, now will be kind of classified under ROU asset model, and that office premises will be capitalized on the balance sheet with a corresponding lease liability. So, as I told you, in a nutshell, all the companies will be kind of doing a finance lease kind of a classification under Ind As 116. Now, because of the application of this new standard, there are a lot of impacts on the balance sheet, P&L, and most importantly, other financial ratios. So it is very, very important for us, like all the CAs, all the accountants, all the finance professionals who are working in the finance department, to communicate the impact of this new leasing standard to all our stakeholders. So stakeholders could be our directors, our investors, our bankers, my stock exchange, etc. Because there is going to be a very, very huge impact on some of the key parameters, key financial metrics pertaining to the EBITDA, your EBIT, your operating cash flows, your EPS, and so many other financial ratios. Further, it is also important that all these calculations which we are doing of capitalizing the lease, depreciating the lease, then recognizing the lease liability as a borrowing, then calculation of the interest on that lease liability may not happen through a simple Excel file, especially when you have huge number of lease contracts. So in that scenario, it may be important for the companies to evaluate whether a new technology is required for calculation the impact of these lease contracts under the new standard. So it is very, very important to study this standard in detail, understand the impact, calculate the impact, and communicate to the stakeholders. So let us understand what is really changing in the new leasing standard. So as you can see on the screen, under Ind As 17, that is an old leasing standard, every lease contract was kind of categorized as finance lease and operating lease. Only finance lease contracts were capitalized on the balance sheet at the present value of all your remaining lease payments with a corresponding recognition of lease liability. And all your operating leases were off the balance sheet. Companies used to recognize only the rent expenditure in your statement of profit and loss over the lease term. Now, under Ind As 116, all your leases will be capitalized on the balance sheet, similar to finance lease transaction. Now, in order to make life simpler, basically the standard has given two exemptions for not capitalizing the lease on the balance sheet. So the first exemption is if my lease contract is of short term in nature, then the company or the lessee can take an exemption of not classifying or not capitalizing it on the balance sheet. So, what is short term contract? Any lease contract whose lease term is 12 months or less is classified as a short term lease contract. So, if my lease term is less than or equal to 12 months, then as a lessee, I need not capitalize that asset on the balance sheet, but I can continue to recognize the lease rent as a part of my statement of profit and loss account, just as we did it for an operating lease model. There is one more exception, which is for low value leased asset. Now, what is low value is not defined in the standard, but in IFRS 16, they have kind of given a guidance that any asset whose fair value is less than or equal to 5,000 US dollars can be termed as a low value leased asset. So it is very important to understand that the low value is considered from the value of the asset and not the value of the lease rentals. So we have to see the fair value of the asset and not the lease rentals for classifying whether a particular lease is of low value assets. Generally, as a part of practical application of this leasing standard, those companies who kind of lease computers, laptops, let's say printers or coffee machines, etc., are generally categorizing such type of assets as a low value assets, and they are not capitalizing these assets as a part of ROU and the lease liability. It has been directly recognized, the rent has been directly recognized as a part of P&L. Moving forward, what has really changed in the statement of profit and loss? So in case of Ind As 17, in case of finance lease, the depreciation was used to get charged on basically the asset capitalized, and the interest was getting charged on the lease liability. In case of operating lease, there was a single rent expenditure that was getting recognized as a part of P&L. So under Ind As 116, the treatment will be similar to the finance lease accounting. There won't be any rent expenditure that will be charged to P&L, except rent on short-term contracts and rent on low-value leased assets. For all other assets, depreciation will be recognized as a part of right of use asset that will be capitalized on the balance sheet, and interest will be recognized on the lease liability. So this has been a massive change for the companies who are having a lot of leases, especially the sectors which got affected because of the new leasing standard was aviation. As you know that most of the aircrafts are taken on lease. Then the retail shops, wherever you see any retail shop which operates on number of branches, those are the sectors which are getting affected. Then those companies who operate on a branch model, like non-banking financial companies, mutual fund companies, asset management companies, again those type of companies got really affected by the introduction of this new standard. So when you apply this Ind As 116, obviously there won't be any change in the total profitability of the company. However, we have experienced that generally when you apply this standard for the first time, the depreciation and interest put together is higher in the initial part of the lease term as compared to the total rent expenditure during in the initial part of the lease term. So the standard kind of, it's not standard, but as per our practical experience, we have seen that the initial expenditure is slightly higher, even though your rental expenditure or rental payments are constant. So as a result of that, a lot of ratios are going to get affected because of the introduction of this new standard. Moving on to the next slide, we already discussed that there are two exemptions. So if the lease term is less than or equal to 12 months, then there is an option not to recognize this particular lease asset on the balance sheet. Or if the lease is of low value like computers, desktops, printers, coffee machines, etc., then again you can opt out not to capitalize of this particular lease asset. So just to clarify that these exemptions have to be applied at, I mean, there is no and kind of a requirement. These exemptions can be independently applied. So the condition is or, not and. So even if you satisfy one criteria, you still may be able to avail the exemption. So coming to the next slide, what will be the impact on your ratios? So it is very important as a finance professional to understand what is the impact, or it is very important for the banks and the lenders also to understand the impact of the new leasing standard on various financial parameters. So for example, your key performance indicator is generally your EBITDA, that is profit before interest, tax, depreciation, and amortization. Now, earlier under the old standard, the rental expenditure was recognized above the EBITDA. So obviously, the rent was deducted while calculating your EBITDA. However, under the new standard Ind As 116, your rental expenditure will be replaced by your interest expenditure and the depreciation expenditure, and hence there is a possibility that there is a significant increase at your EBITDA levels. So that does not really mean that just because of the introduction of this new standard, your operating margins have really increased. So in some companies, we have seen that the EBITDA has increased by almost 40% as compared to the comparative results just because of the introduction of the new leasing standard. So it is very important to communicate to all your stakeholders that this increase is may not be associated only with the actual increase in the profits, but it may be on account of the introduction of the new leasing standard. Then some of the other key ratios that are getting impacted is operating cash flow. So operating cash flow certainly will increase because now we are not classifying rental expenditure as a part of the operating lease expenditure. So your lease payments will be now classified under the financing activities. So your operating cash flows will increase, and simultaneously your financing cash flows will decrease. So again, there is going to be a significant change in your cash flow statement as well. So while reading the cash flow under the new standard, you should be making note of this particular change. Then similar to your EBITDA, your EBIT is also going to increase. This is also considered to be one of the important measures for measuring your operating profits. EBIT is nothing but your earnings before interest and tax. Now, since the interest expenditure will be recognized below the line because of the leasing standard, there is a possibility that your EBIT is also going to increase. Then other ratios, for example, asset turnover ratios, which is calculated as sales divided by your total assets, is going to decrease significantly because when I apply this standard, the lessee is going to capitalize the lease contract as right of use assets just below your fixed assets or property, plant, and equipment. So in this case, your sales will remain constant, but your assets is going to increase, and hence there will be a significant decrease in the asset turnover ratio. Then one of the most important ratio is a gearing ratio or debt equity ratio, which is liability upon equity. Now, because of this new leasing standard, all the lease liabilities will be recognized as a part of your financial liability. So it will be recognized either as a part of your borrowing, or it will be separately recognized on the face of the balance sheet, or it may be clubbed as other financial liability. So since the liabilities are increasing and equity is remaining more or less constant, there is going to be a significant increase in your debt equity or leverage ratio. So it is very important to communicate this change, especially to your bankers or your lenders, because there is a possibility that due to increase in your leverage ratio or debt equity ratio, your floating rate interest rate might increase. So very important to communicate this well in advance and change the parameters of your loan contract. From the interest coverage perspective, the interest coverage may increase or may decrease because the EBITDA as well as interest expenditure both are increasing. So depending on the characteristics of your lease contract, there may be increase or there may be decrease in your interest coverage ratio. So because of the introduction of this new leasing standard, these are some of the highlights where the financial ratios are going for a toss. And as a finance professional, we communicate well in advance to all your stakeholders who are interested in a company. Now let's come to the technical discussion on this topic. So with the introduction of this standard, there is a brand new definition of a lease contract or what constitutes as a lease. So even though there has been a new definition under Ind As 116, more or less practically we have seen that those contracts that were earlier determined as a lease contracts more or less will continue to be classified and as lease contracts even under the new definition. So new definition is pretty robust, and it eliminates all other interpretations in Appendix A, B, C of Ind AS 17 that we used to consider to consider whether a particular contract is a lease contract or not. So the lease definition is pretty simple. It says it is a contract or it is a part of the contract that conveys the right to use an asset for a period of time in exchange of consideration. So there are three important factors. First of all, there should be a contract. It can be oral or written. Then there should be a right to use an asset, which is the most important part of a lease contract. Then the time period should be specified in that particular contract and against the consideration. Now, there are three primary parameters that needs to be satisfied in order to classify a particular contract as a lease contract. So the first parameter is whether there is an identified asset. So what is an identified asset? So in 99% situations, we enter into a contract where I cannot or the lessor cannot fulfill the obligations unless a particular asset is used. So for example, if there is a contract for leasing of office space, then office will be an identified asset. So in majority of the cases, there is the asset is specifically or explicitly mentioned in the contract. In some cases, it is implied that without a particular use of an asset, you cannot fulfill the contract. For example, let us say I have entered into a contract with a bus operator to provide the conveyance services to the employees of my company. Now it is implied that without the use of a bus or a cab, the tour operator or the bus operator cannot fulfill the promise of providing this obligation. So in this particular case, it is implied from the contract that there will be a use of an asset. Now there is one more important clause in the lease definition which says that the lessor should not have substantive substitution rights. So what does that mean? So that means that if a lessor is providing an asset on rent, that lessor should not be in a position to substitute that particular asset. So for example, let us say I have availed an office space on the rent, then of course the lessor cannot say that for first 2 months use this office space, then easily he can substitute for any other office space. So it is not economically and practically possible just to start substituting the office spaces. However, let us say I have entered into a contract with a bus operator to provide the buses on rent for the commutation of an employee or cabs for the commutation of an employee. Then the lessor is in the position to use either one of its bus out of its fleet or either one of its car out of its fleet for the commutation of employees. So in this case, we are saying that it is economically and practically possible for the lessor to substitute buses or cabs for providing a particular service. So in this scenario, if a substantive substitution right is available with the lessor, then a particular contract will not be classified as a lease contract. So this is one of the most important conditions, that there should be an asset. It should be implied or it is implicitly or explicitly identified in the contract, and the lessor should not have substantive substitution right. Then the second condition is customer controls the use of an asset. So just to note, that both these conditions should be simultaneously satisfied. So the condition is and not or. So if one of the conditions is not satisfied, it will not be treated like a lease contract. So the condition is, second condition is, customer should control the use of that particular leased asset. So when we can say the customer can control the use, so in that the first condition is the customer or the lessee should avail substantially all the economic benefits arising from that particular asset. Now, what is substantial is not defined in the contract. Generally, it is assumed that more than 90% of the output from that asset has to be consumed by the particular party, that is a lessee. In that case, we can say that substantially all the benefits are obtained from that leased asset. So, for example, let us say I have taken an office premises on rent. So if my company or my firm is able to use that office throughout 24 hours, 365 days, I am not sharing this office with anyone, then I can say that I'm availing substantially all of the benefits from this particular asset. But let us say if tomorrow the lessor is giving the office space on rent, and he is also accommodating three other chartered accountants in the same office. So we are sharing the office space between three of our chartered accountants friends. Then as a CA firm, I am not actually obtaining all or substantially all of the benefits from the leased asset, and hence this will not be treated as a lease contract. So that is a very important condition. Then the third condition is the customer should be in a position to direct the use of an asset. So for what purpose the asset will be used, when that asset will be used, how many quantities of output will be produced from that asset. So all the major decisions about the usage of that asset should be available with the customer. So in all these three scenarios, if all these three conditions, that is identified asset, all the benefits to be consumed by the customer, and the customer should be in a position to direct the use of an asset. If all these three conditions are satisfied on a cumulative basis, then only a particular contract is classified as a lease contract. Otherwise, it will be termed as a service contract. So, as I said, in my practical experience, in 99% cases, it will be a very, very straightforward exercise of determining whether a particular contract is a lease contract. In that 1% cases, you may have to apply the logic and the definition in detail to check whether a particular contract is a lease contract. So, in a telecommunication industry, generally, this is a very gray area where a particular lessor owns a telecom tower, and that same tower is kind of shared by a lot of telecom users. So in this case, you need to go into deep into the definition and check whether all the conditions of this definition are met, and then classify your contract accordingly. But otherwise, this exercise of classification is going to be straightforward in majority of the cases. Moving on to the next slide. Now, we all discussed that when I have a particular lease asset, the lease will be classified under ROU. So I will pass a simple accounting entry on the inception of this lease contract, which is debit right of use asset and credit the lease liability. Now, what is a lease liability? So lease liability is nothing but it is the present value of all the unpaid lease payments as on the particular date. Now, how do I discount that particular lease liability? So it is same as we have studied under Ind As 17. So if the interest rate implicit in the lease is available with the lessee, then the lessee has to use that rate. If that is not determinable, then lessee's incremental borrowing rate will be used for discounting the unpaid lease rentals. So interest rate implicit in the lease is nothing but it is an IRR internal rate of return from the lessor's perspective. Generally, in Indian scenario, IRR or implicit interest rate is not available from the lessee's perspective, and practically, in majority of the cases, lessee's incremental borrowing rate is used for discounting the lease liability. Now, how do you compute the lessee's incremental borrowing rate? It is nothing but what you need to do is you have to take your lease contracts. Let's say that the lease contract is for 5 years and the total rent payable during that lease contract is, let's say, 10 lakh rupees. So we need to check if I have to go to the bank today and borrow 10 lakh rupees, which has to be repaid over next 5 years with a collateral of the underlying asset. What will be the interest rate that the bank will charge me if I have to give the borrowing of 10 lakh rupees? So it is as simple as that. So whatever is a bank rate, that will be classified as lessee's incremental borrowing rate. So some companies who are already having debt or loan on their balance sheet may make reference to that particular interest rate, or those companies which are debt free may request their banks to provide them the incremental borrowing rate. So both options are possible. So once the lease liability is recognized on the balance sheet on my lease commencement date, it is subsequently measured using an effective interest rate method, just like you use it for your any other term loan account. Moving on to the next slide. What constitutes my lease payments? So we discussed that, okay, my lease payments, my future lease payments are required to be discounted to the present value, let's say using the incremental borrowing rate. But what I really need to consider as a part of my total unpaid lease payments. So there are five important criteria or five important factors that needs to be considered while calculating your unpaid lease payments. So first is a very common criteria, which is a fixed payment. So fixed payment is nothing but the rent which is agreed in the contract that needs to be paid the lessor over the lease term, which includes the escalated rent as well. So let's say it could be 50,000 per month, or let's say 50,000 per month in the first year, and then it will be, let's say, escalated by 5% every year. So you know what is going to be the fixed amount of payment that the lessee is going to make to the lessor during the lease term. Second is the variable lease payments. Now, in this case, we need to consider the variable lease payments which are based on index rate or market rate. So what do you mean by index or market rate? So in some countries, your lease payments escalation is based on the consumer price index or wholesale price index or any other particular index or market rate. So let us say my inflation rate or consumer price index is increasing by 5% every year, then that increase in the escalation of your rent is kind of based on the increase in the consumer price index, or it is linked to the inflationary conditions of that particular country. So in this scenario, the entity, the lessee, needs to estimate that what is my current consumer price index or what is my current inflationary factors in this particular country, and estimate the total rent that will be payable to the lessor. And as and when this rent changes, you may have to do certain changes in estimates and apply the remeasurement of modification principles for the lease payments. This is one scenario that you need to consider while calculating your lease payments. But there is also a possibility where your variable lease payments may be based on the usage of that asset or the turnover of the particular company. So in that particular case, the standard specifically says that it will not be considered while calculating your lease payments. So just to give an example, let's say we all go to the malls for shopping. So in most of the cases where my brand shops or food courts are located in the malls, the rent arrangement is like the rent will be calculated as 10% of the sales for that particular month. So in this scenario, your entire lease payments is based on the sales or the turnover of that particular entity in that particular month. So sitting today, we really don't know what is going to be the rent payment at end of each month. In this scenario, the standard says it will be considered as a contingent rent, and that contingent rent will be recorded in your statement of profit and loss as and when it is incurred. So if you compare the old leasing standard and the new leasing standard, under the old standard, under Ind As 17, entire variable lease payments were considered to be a part of contingent rent. But under the new leasing standard, variable lease payments, which are based on index or market rate, will be included as a part of lease payments. But variable lease payments, which are based on sales of the company or turnover of the company or usage of an asset, then it will be excluded while calculating your unpaid lease payments. So it is very important to differentiate two for the calculation of the present value of lease liability. The third thing is residual value guarantee. So in some contracts, we have seen practically that the lessee promises some lump sum amount as a guarantee that has to be paid by lessee to the lessor at the end of the lease contract. So if the lessee is expecting to pay that amount, then it will be considered as a part of your total lease payment. Then the fourth point is the purchase option. So in some contracts, lessee has an option to purchase an asset during the lease term or at the end of the lease term. So if it is reasonably certain that the lessee is going to exercise that purchase option, then it said that the purchase option value on an estimated basis will be considered to be a part of lease payments. And last but not the least, if the lessee is paying some penalties or some termination amounts, in that scenario, any amounts paid as a penalty for early terminating the lease contract will also be considered as a part of the lease payments. That will not be initiated generally at the start of the lease term, but that could initiate during the lease term because of the early closure of the lease contract. Now, there is also one clarification which is issued by Institute of Chartered Accountants of India in its educational material on Ind As 116 leases. Generally, the lessor, in addition to the lease rent, also adds the GST component on the rent, and the entire amount is paid to the lessor, including GST. So, whether the GST will be included as a part of the lease liability. So Institute has clearly clarified that GST, whether it is refundable or not, that means if you are able to take the input credit or not, will be excluded from the calculation of the lease liability, because it is not considered as a part of lease payment. You are not paying that amount for the usage of that asset, but you are paying that amount to the government, and lessor is merely acting as an agent. So, since we only recognize the lease liability, GST component will not be included as a part of the lease payment calculation. A very important clarification issued by ICI. Moving on to the next slide. So we discussed what is included as a part of lease liability. Now we will discuss what is included as a part of right of use asset. So in most of the companies, on your initial recognition of lease contract, you will pass a journal entry as debit right of use asset and credit lease liability. Now, in addition to these components, there are several other components that we need to consider while recording your journal entry under Ind As 116 leases. Now, what does right of use asset component include? So it includes present value of lease liability that we have already discussed. But in addition to that, it also includes certain other parameters like first, initial direct cost. Now, what do you mean by initial direct cost? It is nothing but any incremental cost which is incurred in arranging a particular lease transaction or negotiating a particular lease transaction will now be capitalized as a part of right of use asset. So to give you an example, it may be stamp duty charges for entering into a contract, or it could be registration charges, or it could also be the brokerage or the commission fee which is paid to an agent for arranging a particular lease transaction. It is very important to note that it has to be incremental in nature. The amounts that you're paying as a part of fixed cost will not be considered as initial direct cost. In under the old standard Ind As 17, majority of the company's initial direct cost was recognized in the statement of profit and loss. Under Ind As 116, initial direct cost needs to be separately tracked by the finance department and capitalized as a part of right of use asset. The third important factor is a prepayment. So sometimes you must have seen that the lessee needs to pay some token amount before the start of the lease contract in order to ensure that a particular lessor has kind of crystallized a lease contract and does not give that particular asset on lease to any other third party. So any amounts which are paid to the lessor before the commencement of any lease transaction is nothing but my prepaid rent or prepayments, which will now be capitalized under ROU asset. Earlier, we used to treat it as a prepaid rent under your balance sheet as my current asset or a non-current asset. Now there won't be any prepaid rent under the new leasing standard, but it will be capitalized as a part of ROU asset. Then the next point is the incentives received. Incentives received will be deducted from the cost of right of use asset. Now, incentives is nothing but it is like a cashback or any amount which are paid by the lessor to the lessee to incentivize him or her to enter into a lease transaction. So similarly, we have a Google Pay cashback, Paytm cashback. In foreign countries, we have seen that the lessor actually incentivize lease in the form of cashbacks in order to enter into a lease transaction. So if lessee is receiving any such cash amounts from the lessor, then that amount will be deducted from the cost of the right of use asset. And last but not the least, the restoration cost or dismantling cost, which the lessee is expected to incur at the end of the lease term to bring the lease asset back to its original form, will now be capitalized under the right of use asset. So this provision was already prevalent under the property plant equipment standard, which is Ind As 16, or even under AS 10. Now under Ind As 116, the lessee is expected to calculate the total restoration or dismantling cost at the end of the lease term, calculates its present value as on the lease commencement date, and capitalize that present value as a part of ROE asset. The provision for dismantling cost will be separately recognized on the balance sheet and will be classified as current or non-current, and the interest will be computed on that particular provision. So effectively, you can see that there will be a debit to ROU asset, credit to lease liability, credit to initial direct cost, credit to prepayments, credit to provision for dismantling cost, and again debit to incentive received. So this is how you will recognize your ROU asset and the lease liability at the inception of a particular contract. The ROU asset will be amortized or depreciated over the lease term using a straight line basis or any other appropriate basis. If a lessee has a purchase option, then the asset will be depreciated over the useful life of the asset and not the lease term. As I told you, lease liability will be treated similar to a borrowing, and it will be amortized using effective interest rate method as per Ind As 109. So interest will be accrued on the lease liability, and whenever the rent amount is paid to the lessor, the rent amount will be bifurcated towards the amount paid for interest as well as amount paid for the principal, and at the end of the lease term your lease liability will be zero and your right of use asset will also be zero. Moving on to the next slide. Now we all discussed that we need to compute your lease payments during your lease term. Now it's very important to understand what constitutes of my lease term. So to give you an example, let's consider a scenario where a lessee has entered into a contract with a lessor for 10 years lease term. So let us say out of which the first 3 years is a non-cancelable lease where neither lessor nor lessee is able to cancel the contract. Fourth and fifth year, only lessee has an option to extend or to terminate. And from sixth year onwards till the end of 10th year, both lessee and lessor has an option to extend or terminate the lease contract. In this example, let us split the definition of lease term. So it says lease term comprises of a non-cancelable period, including the rent-free period. So we all know what is non-cancelable period. It is a period where neither lessee nor lessor can cancel the contract. So in our example, the first 3 years will be considered as a part of lease term. Then second is lessee has an option to extend or terminate, and the lessee will include that particular period in your lease term only if the lessee is reasonably certain to extend or not to terminate. So whether to include fourth and fifth year as a part of lease term will be based on the judgments exercised by lessee. So as a lessee, we need to consider several factors like whether I have incurred a significant cost on leasehold improvements so that I will continue the lease for a larger term. So for example, let us say let's say we have taken a CA office on rent, office rent on office space on rent, and I have incurred massive cost in doing leasehold improvements, doing false ceiling, painting, and a lot of things which cannot be removed easily or which I cannot take along with me in the new office. Then in order to recover the cost of my significant leasehold improvements, as a lessee, I will definitely try to utilize as much period possible of my lease term. It is also important to note what is the if I am taking office space on rent, what is the location of my office, what is the rent payments that I'm paying during that extended term, whether it will be lower as compared to the fair value of the rent in the fourth and fifth period at that particular time. So there are a lot of factors that the lessee needs to take into account while considering a decision whether the lessee will extend the option or it will terminate. So if it is reasonably certain that the lessee is going to continue in fourth and fifth year, then the lessee will consider fourth and fifth year as a part of lease term as well. So in our example, 1 to 5 years is considered as a part of the lease term. The fifth is lessor has termination option. So it says that if only the lessor has a termination option and lessee does not have a termination option, then the period under which only the lessor has a termination option should be included as a part of the lease term. Because as a lessee, I really do not have any say whether the lessor will terminate the contract or continue the contract. So in that particular period, the lease term, I mean, the period under which only lessor has an option will be considered as a part of the lease term. Now, in our example, from the year 6 to year 10, both lessee and lessor has an option to extend or terminate. So the standard says if both lessee and lessor has an option to terminate without incurring significant penalties of exiting into a lease contract, then such contract from period 6 to period 10 is really not enforceable, because at any time, let's say by giving 1 month's notice, the lessee or lessor can exit the contract. Such period will not be considered as a part of the lease term because such contract is not enforceable by law and it can be cancelled by any time, either by lessee or lessor, by giving a short period notice, let's say 2 months, 3 months, or 6 months. So this is how we need to basically evaluate in the total contract term what should be considered as a lease term, because after evaluating or after finalizing the lease term, the lessee will consider the lease payments for the discounting purpose. So there are a lot of clarifications which are issued by Institute of Chartered Accountants of India through the educational material, as well as ITFG bulletins issued by Ind As Transition Facilitation Group. So if one needs to understand the lease term in detail, they can definitely look into educational material as well as ITFG bulletins. Moving forward, I'll just take a numerical example to explain you how these amounts are calculated, how these assets and liabilities are recognized. So let me read out an example for you. Lessee ABC enters into a contract with lessor XYZ for the right to use an office space for 10-year term. The right to use office space is a lease and therefore no other components of the contract. The following facts are relevant on the lease commencement date. So the total lease payments are fixed payments of 14,527 per year in arrears with 3% increase every year after year one. Then we also have a renewal option where there is a 5-year extension after the 10th year, where the amount will be 19,523 per year from 10th year onwards or from 11th year onwards, with 3% increase every year after year one of extended period. My lessee's incremental borrowing rate is 10%. Implicit interest rate cannot be determined. And initial direct cost incurred by the lessee is 5,000 rupees. So how do I determine the right of use asset? Assuming that the lessee will not exercise the lease period from 11th year to 15th year. So the renewal option is the lessee is not going to exercise in the renewal option. So how do I compute the lease liability and asset? So basically, I compute all the cash flows on the during the lease term from year 1 to year 10. So if you can see 14,527, 14,963. So that is nothing but there is a 3% increase in the rental amounts every year. So my total rent is 1,66,535, and in an extended period, my lease rental is 1,03,651. So we have assumed here that the lessee is not going to exercise the extended period option. So as a lessee, we will consider only the rents from year 1 to year 10, which is 1,66,535. That will be discounted at the rate of 10%. So if you use Excel, if you use the calculator, the present value of all these 10 lease payments will come to 1 lakh rupees. Uh, Further, we also have right of use asset. Further, we also have initial direct cost, which is incurred by the lessee to the extent of 5,000 rupees. So, on inception of this particular lease contract, the lessee will recognize right of use asset of 1,05,000. It will recognize a credit of lease liability of 1 lakh, and the remaining credit of 5,000 will be to the initial direct cost. So initial direct cost can be debited first while it is making while the payment is made, and then it will be capitalized as a part of right of use asset. So even two entries can be made: asset to liability of 1 lakh each, and then asset to initial direct cost of 5,000 each. So that is how my asset, my liability, my initial direct cost is recognized on the commencement of a particular lease transaction. As I said, this 1,05,000 will be amortized or depreciated over the 10 years period, and 1 lakh rupees will be recognized using the effective interest rate method. So every time when this 14,527 rupees is paid, it will be divided into interest portion and towards the payment of lease liability. At the end of year 10, your lease liability will become zero and your right of use asset will also become zero. Moving on to the next slide, currently we discussed the model, accounting model for lessee. We also have a lesser accounting which is substantiated in Ind As 116 leases. However, there is no substantial change in the lesser accounting which is prescribed under Ind As 116. The lease classification test continues under the new leasing standard. So lesser is still required to classify a lease as an operating lease or a finance lease. The lesser still needs to apply those 5 to 6 criteria for classification test and classify a particular lease as a finance lease or operating lease. The accounting treatment of the lesser continues as it is, where we have studied under the old leasing standard under Ind As 17. So if you compare the lesser model and the lessee model, it is completely a asymmetrical model for lease accounting. So there is no mirror image between lesser accounting and lessee accounting. Earlier, under the old standard, there was a mirror image of accounting. But under Ind As 116, there is a possibility that the lessee will capitalize the asset as ROU asset, which is nothing but the present value of lease payments. And lessor also continues to capitalize the same asset as a part of my Ind As 16 property, plant, and equipment. So there is no mirror image, there is an asymmetrical model. So while auditing, one needs to understand that you will not exactly get the perfect balances of lesser and lessee. Moving on to the next slide. So there are certain other changes in the standard. There is a lot of guidance in the standard with respect to the remeasurement accounting, modification accounting, or termination accounting. So there is a lot of there is a possibility that even if I consider a particular lease period of, let's say, 10 years, let's say at the end of sixth year, the lessee decides to extend or avail the extension option from 11th year to 15 years. There is a possibility that the lease term or lease amounts may get modified during the lease term. So especially in this COVID-19 situation, all the lessees in the retail sector and other sectors are negotiating with the lessor for the waiver of rent for a particular period or kind of postponing the rent amounts. So it is but natural that every lease transaction or majority of the lease transaction may undergo a change in either the total lease term or the total payments made during the lease term. In such case, the standard has clearly given how to account for such changes using remeasurement principles or the modification principles, or in case there is the early termination of lease contract, then the termination accounting will be applicable. So due to limitations and paucity of time, we are unable to discuss such changes in today's session. But I'm sure that once you go through the educational material or the bare text of the standard, you will be able to get such changes. Then the standard has also kind of prescribed the new lease accounting in case there is a sublease or a sale and lease back. So sublease is nothing but, let's say I am a lessee, I take a particular asset on lease from the lessor and I give the same asset on lease to some different person, to the third party. So in case there is if any asset is taken on lease and given on lease immediately, either on a full basis or a partial basis, that is called as a sublease. And in case of sublease, there are different guidelines which are issued under Ind As 116, which are different from the old leasing standard Ind As 17. There is also a possibility that a lessee may enter into a sale and leaseback transaction, especially for financing purpose. Sale and leaseback is nothing but a particular asset is basically sold and then same asset is taken on lease. So that is known as sale of an asset and the same asset is taken back on lease. So again, Ind As 116 prescribes detailed guidelines on accounting for sale and leaseback transactions, which are a little bit of complex nature. So given the paucity of time, we'll not be able to discuss these changes, but yes, there are definitely important changes which may not impact all the lessees, but it may impact in few certain exceptional circumstances. Then there are certain additional disclosures which are required as per Ind As 116 and a combination of Ind As 107 financial instrument disclosures. So, what is the asset capitalized? What are different classes of assets? Depreciation during the period, interest expenditure during the period. What is my payments for a short-term lease? What are my payments for low-value leases? What are my variable lease payments? The movement of lease liability, etc., etc. There are a lot of additional quantitative as well as qualitative disclosures which are prescribed under Ind As 116. And lastly, but very important is you also need to consider the deferred tax implications on adoption of Ind As 116, typically from a lessee's perspective, because the lessee is not the owner of the asset. However, lessee is still recognizing the depreciation on the asset capitalized as well as interest on the lease liability as against the rental expenditure in P&L. So typically, from an income tax perspective, the income tax department may not allow the depreciation and interest on the asset capitalized and interest on the lease liability, but may only allow the actual rent which is paid to the lessor. So in this scenario, there will be a temporary difference which will arise on accounting under Ind As 116. So typically each contract will give rise to a deferred tax implications. So it is very important to consider the impact of deferred taxes on account of implementation of new leasing standard Ind As 116. Moving on to the next slide. So we discussed the brief provisions of the new leasing standard. However, it is also important to understand how a particular lessee or an entity moves from the old leasing standard to the new leasing standard. So Ind As 116 has prescribed certain transitional provisions for ease of transitioning from the old standard to the new leasing standard. So typically, there are two approaches which are prescribed under Ind As 116. First is known as a retrospective approach, and the second is known as a modified retrospective approach. So I'll just go to the next slide and come back to this effective date. So as I said, there are two primary transition approaches, retrospective and modified retrospective. So retrospective approach is nothing but when a lessee applies this particular approach, it will apply as if the company has followed this particular standard the day when it came into existence. So you will apply a approach similar to how you apply a change of accounting policy as per Ind As 8. So what you need to do as a part of retrospective approach is on as a lessee, the entity needs to go back to the comparative period and restate my comparative period, including the opening balance sheet at the start of my comparative period. So if I go back to this slide of effective date, assuming that a company is applying Ind As 116 first time from 1st April 2019, and 1920 is the financial year where it will report its first Ind As numbers. So if the company has decided to follow the retrospective approach, then the company needs to go back 1 year, restate the comparative period as if Ind As 116 was applied right from the day when the company came into existence. So how do I do it? I take 1st April 18 as an effective date of transition to Ind As 116. The company evaluates all the open lease contracts as on 1st April 2018, which is my first day of my comparative period. Then the company calculates the cumulative impact that would have been there as on 1st April 18. So the company will recognize right of use asset on 1st April 18. It will recognize the lease liability as on 1st of April 18, and the balance amount will be recognized in equity typically in the retained earnings as on 1st April 2018. So this is the beginning of my application of new leasing standard. I have to go back, restate comparative periods. If the entity is listed company, then the effect of the application of this standard needs to be given on the quarterly basis, that is 30th June 18, 30th September 18, and 31st December 18, and then come to the current period where again the current quarters will be restated as per Ind As 116. So this approach will ensure that there will be comparability between two accounting periods, which is 1819 comparative year and 1920, which is the current period under Ind As 116. However, practically it is very difficult to implement this standard on a retrospective basis because of the lack of information and the complexity in the lease contracts which the clients are facing. So if you go and search the financial results of the listed companies, there will be very few entities who have opted the retrospective approach because of the lack of information that was available at the start of the lease contract. So we need to consider all the parameters, that is initial direct cost on the date of commencement of the lease, borrowing rate as on the date of commencement of the lease, had there been any changes from the commencement date till 1st April 18, and then process all those changes, modifications, remeasurements, and then apply the new leasing standard. So it is quite complex for an entity to use the retrospective approach. In case the company is not able to use the retrospective approach, the standard had also given one more approach, which is called as a modified retrospective approach. So I'll just go to the next slide to explain the modified retrospective approach. So the important advantage of modified retrospective approach is that the entity who is applying Ind As 116 for the first time is not required to restate the comparative period for 1819. The entity will apply Ind As 116 directly from the start day, or the first day of the current financial year, which is 1st April 2019. So the asset is computed on a retrospective basis, and lease liability is computed on a prospective basis. The difference between the two is recognized in retained earnings in option A. So the important objective is not to restate the comparative year. So on 1st April 2019, my asset will be recognized. Lease liability will be nothing but present value of the remaining lease payments, and the difference amount will be recognized in retained earnings on 1st April 19. So this is given on in option A. So in modified retrospective approach also you have two options. So we just now discussed option A. So option A is nothing but it is a retrospective approach without changing the comparative year, but directly giving the impact in the current financial year, that is 1920, with additional exemptions. So we'll see what is those additional exemptions. In order to simplify the transition more, the standard also gives you option B, that is you do not restate comparatives for 1890, plus you calculate the present value of lease payments on 1st April 2019. Whatever is the value of the liability, that becomes the value of the asset. So in this option B, we call it as a more like a modified prospective approach, where the entity need not go to the computation right from the commencement date of a particular lease contract. It needs to only consider the lease payments for the balance lease term and not the lease payments for the amounts which are paid before 1st April 19. So from the application perspective, from the transition perspective, option B is the most simplified approach which the entities can consider. There is also a possibility that for some contracts, the entities may choose option A, and for some contracts, the entities may choose option B. However, they need to choose one of the approaches, that is retrospective approach or the modified retrospective approach. So in case modified retrospective approach is selected, the entities will directly recognize the impact of Ind As 116 for the first time on 1st April 19, and if it is a listed company, then the impacts will be computed on a quarterly basis. It need not restate the comparative year. So if you are using the modified retrospective approach, the standard has given few more exemptions that I will take you through. So in case of modified retrospective approach, the entity can apply a single discount rate to the portfolio of the leases with a similar characteristics, and the discount rate can be determined as on 1st April 2019. The entity need not go back to the lease commencement date for the determination of discount rate. So it is very important exemption. The second exemption is the companies may rely on the assessment of the owner's contracts of leases that we have studied under Ind As 39 and Ind As 37 as an alternative to impair the right of use asset. So this exemption may not be relevant for many companies because majority of the companies have not recognized the provision for the onerous lease contracts. The third important exemption is the entity or the lessee may not apply the lease accounting to leases for which the lease term ends within 12 months from the date of initial application. So to give you an example, let us say my original contract is for 5 years, but let us say my lease end date is let's say 31st December 2019. So I'm applying 116 for the first time on 1st April 2019. So this lease contract, even though the original period is more than 12 months, this particular contract is getting over on 31st December 2019, which is just 9 months from the date of initial application of this leasing standard. So if I consider the third exemption, not apply lease accounting to leases which the lease term ends within 12 months of the date of initial application. So for such type of contract, which, yes, Karan? So just got a message, guys, that there was some problem from the connectivity perspective for last 2 minutes. So I'm just kind of recapturing the details which we kind of discussed right now. So we were discussing the modified retrospective approach, option A and option B. So we discussed that the companies on a selective basis can either apply option A or option B, lease by lease basis, with certain additional exemptions which are available under modified retrospective approach, but those additional exemptions are not available under retrospective approach. So let us see what are those additional exemptions which are available under modified retrospective approach, where the companies are not required to restate the comparative period. Coming to the next slide. So there are 5 transition exemptions which are available with the lessee. All these exemptions are optional in nature. So if the lessee wants to avail, they might go and avail those exemptions. Otherwise, the lessee can simply ignore these exemptions. So the first exemption is the lessee can apply a single discount rate to the portfolio of leases having the similar characteristics. So let us say if I have 500 lease contracts for my office spaces or branches or my retail chains having similar characteristics, then I can have one single discount rate which can be determined as on 1st April 2019 for the computation of my lease liability. So if I have to apply a retrospective approach, then I have to go back to the initial date of the contract, that is lease commencement date, to find out the borrowing rate of each contract separately. But in case of modified retrospective approach, I can determine this discount rate on 1st April 2019 by being my initial date of application, and that rate can be similar across the portfolio of lease contracts. So it's big relief for the lessees not to go back to determine my borrowing rate. Then the second exemption is the lessees or the entities can rely on the assessment of onerous lease contract as an alternative for the impairment review for the right of use assets. So once a particular right of use asset is recognized in the balance sheet, all the impairment provisions under Ind As 36 will be applied to those right of use assets as well. So there is a one-time exemption which says that you may not apply the impairment review provisions on 1st April 19, but you can rely on the assessment of whether a particular lease is onerous or not, which you may have applied under the old leasing standard Ind As 17 in a combination with Ind As 37 provisions, contingent liabilities, and contingent assets. So this exemption may not be really useful for majority of the companies, since in my practical experience I am not seen many companies recognizing the provision for the onerous contracts. The third exemption is very important, which says a lessee may not apply the lease accounting, that is capitalizing the leases on the balance sheet, for the leases for which the lease term ends within 12 months of from the date of initial application of this new leasing standard. So to give you an example, let's say my initial date of application is 1st April 2019, and I have a lease contract where my original lease term is 5 years. So it is no longer a short-term contract. However, my lease end date is, let's say, 31st December 2019, which is 9 months from the date of initial application of the new leasing standard. So the transition exemption says that if there are any leases which are about to expire within 12 months from 1st April 2019, then you may not include those leases in the computation of my asset and liability as on 1st April 2019. But these leases will be included only once they are renewed after the original lease end date gets over. So it's a big relief for the companies whose majority of the leases are getting over within 12 months from 1st April 2019. Then fourth is exclude the initial direct cost from the measurement of right of use asset. So in our earlier discussion, we kind of deliberated that all my initial direct costs like stamp duty charges, registration charges, brokerage charges, etc., will now be capitalized as a part of right of use asset. Earlier, these costs were recognized in my P&L. Now, it would be a very cumbersome exercise to go back and find out what are my initial direct costs for each and every lease asset. So, to give a one-time exemption, one-time transition exemption, the standard says that on 1st April 2019, the lessee may not go back and check and calculate that what was the initial direct cost incurred at that time, and again capitalize it as a part of right of use asset. So you can simply ignore the capitalization of initial direct costs for the assets which are recognized on 1st April 19. However, if any new contract is entered after 1st April 19, or if any existing contract is modified after 1st April 19, then the lessee is required to capitalize the initial direct cost as a part of right of use asset if at all the lessee has incurred such costs. So again, important exemption because it will save a lot of time and energy to go back and dig all the details relating to the initial direct cost. And the last exemption, transition exemption is the lessee may use the hindsight for determining the lease term. So, for example, let us say my original contract was 5 years, but as on 1st April 19, the lessee already knew that a particular contract had been already extended to 8 years. So my original contract was 5 years, and my extended contract is in total is for 8 years. So I need not go back an account as if my contract is for 5 years and again apply the remeasurements or modification principles. But instead, I can use the hindsight because I'm already, let's say, 2, 3 years down the line ahead of time, and then I'm applying the new leasing standard. So I already know the information as on 1st April 19 that the contract has been modified and it is extended to 8 years instead of 5 years. So I can use such information for determining my lease term instead of using 5 years as a base and again applying the remeasurement and the modification principles. So these transition exemptions will surely make life easier for all the lessees, especially when there are high volume of lease contracts. So in my practical experience, I have seen companies having right from 10 lease contracts to 27,000 lease contracts. So in such scenario, it is very important to kind of decide that which tool will be useful for the computation, then computation of the calculations, then calculating, so putting the calculation into the journal entries on a monthly basis, and again putting the journal entries into the various disclosure requirements as required by Ind As 116. Moving on to the next slide, I have tried to capture some of the excerpts from the annual report of few listed companies where they have already kind of released the annual report for 31st March 20. So if you can see on your screen, in the balance sheet ended 31st March 20, there is a new line item in the annual report in the balance sheet, which is called as right of use assets in note number 2.3, where around 2,800 crores of right of use asset has been capitalized by a particular company. And if you see the comparative year, the amount is nil. That means the company has used a modified retrospective approach while making a transition to the new leasing standard. So generally, right of use asset will be disclosed separately on the face of the balance sheet if the amount is material. The other option is some companies may include it as a part of property, plant and equipment, and thereby giving a separate schedule for property, plant and equipment and right of use asset module. So on the liability side, you can see as a part of non-current liabilities and as a part of financial liabilities under non-current liabilities, the company has separately classified lease liability as a separate line item on the face of the balance sheet, both under non-current liability section as well as you see in the current liability section, we have a lease liability because ultimately, like any other liability, lease liability will also be bifurcated into current and non-current section. Moving forward, again, some of the excerpts. So these is basically the ROU schedule, ROU asset schedule, where the category of ROU is mentioned, like there is land which is taken on lease, there are buildings which are taken on lease, and of course there are some computers. So balance, opening balance as on 1st April 19. Then there are certain reclassifications which are done from PP to lease assets. Then additions during the year for the contracts which are entered during that particular period. Then there are certain deletions for the contracts which ended in the 1 year period, and of course the depreciation on the ROU asset and the net block as on 31st March 2020. It also says that the aggregate depreciation on ROU asset is included under depreciation and amortized section under the statement of profit and loss. So this is an asset. From the liability perspective, also we have few disclosures that how the liability is bifurcated into current and non-current portion, and how the liability, the basically the reconciliation of liability at the beginning and at the end of the financial year. What is a liability at the beginning? Additions during the year, then the interest expenditure incurred during the year, deletions for the amounts or for the contracts which got over during the year or terminated during the year. Then the payment of lease liabilities during the period. The translation difference, especially when the lease contracts are in foreign currency and there are certain non-integral operations which the entity has, mostly from a branches perspective, are also recognized in the liability movement, and of course the balance at the end. And we also have disclosures relating to the contractual maturities of the lease liability on an undiscounted basis. If you see, this disclosure was already there under the old leasing standard, Ind As 17. That is the amount, the contractually payable amount to the lessor in next 1 year, 1 to 5 years, and more than 5 years. So this will give a overall idea to the stakeholders and to the users of the financial statements, that what is going to be the total outflow relating to all the outstanding contracts as on 31st March 20. And lastly, you can also see that what is the total rental expenditure which is recorded for the short-term lease contracts, which is 37 crores for the financial year ended 31st March 20. And the company also acts as a lessor in certain leases where they have given a disclosure what is the rental income which is recognized in P&L for the financial year 1920. So these are some of the disclosures, just to give you an idea that how these assets and liabilities and other amounts are reported as a part of your balance sheet, P&L, and other disclosures. So as I discussed earlier, that due to the paucity of time, we could discuss only the important concepts of the standard, how the standard is changed, what is the financial impact on various financial ratios, the balance sheet, recognition of asset, liability, interest, depreciation, etc. However, if you want to learn this standard in detail, you can always refer Ind As 116 leases bare text, which is released or notified by MCA, Ministry of Corporate Affairs. We also have basis of conclusions under IFRS 16, which is available on ICI's website under the resources section, under the accounting standards section. So if you really want to understand that why a particular provision was kind of entered into the standard, how it was deliberated, what were the odds in favor of bringing a particular change in the standard, all these things you can read in basis of conclusion for the better understanding of your standard. In addition to that, if you want any clarifications on how to determine the lease term, what will be the journal entries in case of remeasurement, modification, termination, etc., then ICI Institute has also released an educational material which is available on Institute's website, which has plethora of questions on how to identify whether particular transaction is a lease contract or not. How do I determine the lease term? How do I recognize? How do I find out the incremental borrowing rate? Whether GST will be included or not? All these questions have been very carefully and nicely answered by our institute under the educational material. In addition to that, institute has also formed a group which is called as Ind As Transition Facilitation Group, which kind of caters to a lot of questions which are raised by the stakeholders or by the users of the financial statements, or those who prepare the financial statements, on how to implement particular provisions of any Ind As for that matter. So they have been issuing bulletins for some time now, and you can see all the important clarifications which are issued by ITFG from bulletin number 20 and onwards. So in last 3 to 4 bulletins, there have been majority of clarifications issued on Ind As 116. So that will also help you in understanding the standard in a better manner. Right. So this is what I wanted to discuss with you all in last 1.5 hours. So I will open the forum for question and answers. So if you have any questions, you can always type in the live box, and I'll try to answer all those questions one by one. So Karan, we can open the floor for question and answers. Okay, so there has been a question which I can see. So I'll read out the question. So there's a question which says that company has building on lease and passes entries as per Ind As 116. Next month, the company purchases the building. There is no disclosure in the contract for purchasing the asset. What entries to pass? Okay. So in this case, what will happen is if the company has already recorded the entries for Ind AS 116, and now it has purchased the asset without a clause of purchase option in the agreement, in that particular scenario, you need to apply the termination accounting first. So whatever ROU asset and the lease liability was recognized as per Ind AS 116 will be reversed, will be derecognized. The difference will be recognized in P&L as a gain or loss on termination of a lease contract. And thereafter, a fresh capitalization entry as per Ind AS 16 will be recognized as per the normal provisions of the standard. So I don't think so there are any other questions here. So Karan, do we have any other questions? So those who are watching live, you can ask the questions in the live comments, and then I can answer those questions one by one. So Karan, are you there?
Yes, sir.
Yeah, so there's only one question which I've answered. We don't see any other questions. Do you want to open the forum for others for Q&A?
Uh,
Otherwise,
s-
we can
I
end up.
don't. Yes, sir. We can just wait for another 2 minutes if there are any questions. I request the members, if you have any questions to be asked, you can please type it in the chat box.
So what I'll do is I'll share my contact details by sharing the screen. So if any members are interested to ask the questions later
I'll
on.
also put in your email address in the description box so that if there are any queries when the members watch it in the recorded form, so they can reach out to you directly.
Sure. So just a second. I'm just
Yes, sir.
sharing the screen again. These are my contact details.
Sir, I have sent the same in the live chat box also. I'll upload it in the description window too.
Sure. All right.
Yes, sir. Sir, thank you so much for accepting the invitation and coming here live on our platform to guide the members on Ind AS 116, a very important topic for many of the professionals who are working in this particular domain. Thank you once again, sir, for being with us here today. Sir, over to you. If you would like to say something else, I think there are no more questions from the members' side. We can conclude then.
Thanks a lot, Karan, and the entire professional forum team for giving me a chance to speak on this forum. I wish you all the best. You are doing a really good job, and all the members. If you have any questions, I am always there to help you out. Any question relating to Ind As, IFRS, US GAAP, Indian GAAP, ready to help you at any point in time. Thank you so much for attending today's session. I hope it was useful for all of you who attended the session. I wish you all the best in your future endeavors and stay safe. Thank you.
We wish to see you back soon on our platform again with a new different topic and new experiences, sir.
Sure,
Thank you so
definitely.
much.
Thanks. Bye bye.